Are you ready to thrive in the UK food manufacturing industry? Welcome to Forking Delicious podcast, stories of UK food manufacturing success with Jaz Note and Alvin Nasi. Join Jaz and Alvin as they chat with business owners, industry pros and experts, sharing real challenges, smart solutions, and practical insights to help you grow your business and thrive. Tune in now.
So, welcome to the Forking Delicious podcast. This is a series of podcasts we're calling the Jaz and Alvin sessions. I think this is some sessions where we're going to be talking about your business, and specifically we're going to be talking about today, or over the next 3 episodes, preparing your business for sale. So, welcome, Jaz.
Hey, Alvin.
Hello. So, as everyone knows, you and I are looking at buying food manufacturing businesses, and one of the things that we find is that, you know, not a lot of businesses that we see are properly set up for sale, are they?
No, absolutely right. And actually, that said, there's actually a statistic to back that up. So 75% of business owners actually want to exit in the next 10 years. However, less than 50% of them have a plan. And by having a plan, the first step of having a plan is having good financials in place. And actually, so many businesses you and I have seen in the recent last 2 years had very poor set of financial information. And when we've looked at trying to come up for a value for those businesses, it's been absolutely impossible because we're waiting on information because the accounts, although they've filed a set of accounts, the quality of information has not been great in order us to, value the business. So
yeah, absolutely. And ultimately, what you're doing as a business owner is you're leaving so much money on the table by not having everything set up correctly, right? And the first thing we're talking about having a good, clean set of accounts or financial hygiene or whatever you want to call it. But why does it matter to have your accounting accounts? Why does it matter to have it nice and clean?
So firstly, most business buyers will value a business by looking at the last 3 years worth of accounts. So we need at least 3 years worth of accounts in order to value the business. Now, also to value, the banks will always also look at the last 3 years accounts. So if a buyer is looking to get a loan to buy the business, then they will need to provide the bank with the last 3 years financials for that business. Also, clean accounts. What the accounts do is they add credibility to your business, to any business. And it's almost like your brochure for your business or part of the brochure for your business. Absolutely. Because it's what adds, this is what dictates what your business is worth. It's the numbers. Businesses are normally valued on a percentage multiplier of EBITDA, which is effectively your profit. And if you've got a good set of financials that are showing strong profitability, strong growth, then your business is going to be able to attract a higher value. Now, a lot of businesses we find, they're normally owner-run and the owner tends to take a lot of personal costs, and they tend to take out a lot of their personal expenses out of the business in order to keep profits down. They might have family members on the books who aren't actually doing any work for the business, and all these items tend to lower the value of your business because they're showing you to have a lower profit margin, and then hence, if your business is being valued as a multiple of your EBITDA, if you're showing a lower EBITDA figure, then you're going to attract a lower value. So it's important to have a good set of clean financials. When you value a business, there is something called add back. So if there's items that have got, to allow for things like this. However, if you haven't got a clean set of figures or a good sort of bookkeeping system and you can't identify those costs, then it's hard to negotiate whether those should be added in or taken out in terms of when it comes to valuing the business.
Yeah, I mean, let's be realistic, right? Most of these businesses are family businesses. And yes, you are certainly going to run through perhaps your wife or your husband through the business, or maybe your kids. You might maybe look at leasing the sports car through the business.
Yes.
Yeah, exactly. And, that's all legit. We're not telling you not to do it. But if you do it, make sure that your bookkeeper or your accountant has got really good line entries or can really justify it, because when you go back to, you spoke about add backs, and we'll get to that in the next section. We're going to talk about, the valuation side of it. But, you just want to make it really easy for the incoming buyer to really cross-reference these things. Otherwise, it's just going to be a dog's breakfast. And when it's a dog's breakfast, it just makes it really, it's too hard to do, too hard to get funding. And I think that funding point you mentioned was really great, because a lot of business owners don't realize that your incoming buyer will need to get funding to buy the business, right? Because you probably had your food manufacturing business for a long time. It's probably worth a fair bit of money, maybe. And not, it makes sense for the incoming purchaser to borrow the money. It doesn't make sense, all your money that you've got in your savings. You can certainly use some of it, but you want to use the right amount of leverage. And that's why it's important, to get bank funding. So you want to be able to present to the bank a clean set of books and that kind of thing. So tell me, Jaz, we've seen a ton of red flags. What are some other red flags that we've seen in the whole financial hygiene side of things?
Oh gosh, a huge amount. Just a couple of examples that really stick out. My team were reviewing a business, and that business was doing a lot of the bookkeeping in-house, and the person doing the bookkeeping wasn't an experienced or qualified bookkeeper, so didn't understand all the rules around VAT. And they had incorrectly been posting the business's sales as exempt from VAT. And so the profit margins are huge on this business. And then actually further digging and during the financial due diligence, it transpired if the buyer bought the business, they could have had a VAT bill going back 21 years that would have wiped out the buyer bankrupt, because the business was not worth that much money. So it could have been a very expensive mistake. So things like, I know when people start the business, they try and do everything themselves, get a partner or a friend to do things for them because they might have a bit of experience in it. But as you grow your business, it's really important that you get the right people involved. So if you've got a business, make sure you've got a qualified bookkeeper or an accountant that are looking after the books to make sure that you're following all the rules correctly. Also, issues we've had is when during financial due diligence, when you've looked at businesses and you've tried to compare VAT returns to the year-end accounts, the numbers haven't tallied, all sorts of things. So it's really, really important to make sure, and this has reduced the value of the business. So the business I was talking about where they hadn't accounted for the VAT, the seller was really keen to sell, wanted to emigrate, couldn't do any of that and had to start from scratch and do it properly. Make sure you get the right advice at the beginning. Get an accountant or a qualified bookkeeper on board to make sure that you are following the rules as you should be. And this all adds to the value of your business going forward. Yep. And actually, even as a business owner, if you're not ready to sell just yet, it gives you better financial information to make decisions.
Yep, absolutely.
Other red flags: supply disputes, employee disputes. Have killed deals where suppliers refuse to supply because there's been an issue with payment, etc. Customers not paying. So another example, we had a business that we looked at that was valued at X million. However, they had probably £300,000 worth of invoices that hadn't been paid for a number of years. So you needed to make an adjustment for that because they were never going to be paid. So just having make sure you're constantly looking at your numbers, looking at your aged creditors, your aged debtors, and anything that looks, really old, deal with it before you sell.
Yeah, absolutely. I mean, and all this whole process of sort of cleaning up your books and making everything, not necessarily legitimate, but making sure that everything's properly set up so that when it comes to sale time, it's already, that can take a little bit of time. You need to start as early as you can. In some businesses, it can be as little as 6 months. In some other businesses, depending on how much of a dog's breakfast it is, it can take up to 3 years. But at the same time, what you're also doing is once you're setting up all these systems and procedures, you're actually starting to create these systems and procedures that will carry forward to the new owner of the business. And having these systems and procedures actually increases the value of the business, because all of a sudden for your invoices, your accounts receivable, you've got a system in place to have your money paid to the business within 30 days or so. So you've got a system for that. You've got a system for managing invoices. You've got contracts in place with your suppliers and your vendors. All of these things, these little tidy up bits add so much more value to your business that you don't even realize. And most, as we see, Jaz, most owners take this for granted, right? It's either all up in their head and they kind of do it on the fly, but very few of them actually take the time to properly implement and sit down and do processes and systems to create this sort of value chain, if you will.
Yeah. And that all, like you said, increases the value of the business.
Yeah. So speaking of valuation, one of the next parts that we're going to talk about now is actually trying to figure out what your business is worth. And I'm going to throw it back to the accountant, to Jaz, because you mentioned this term EBITDA. Could you be so kind as to explain what EBITDA is?
EBITDA is an acronym for earnings before interest, tax, depreciation, and amortization. A figure that most companies use in order to measure or to value a business. And the reason you add things back like interest, depreciation, and tax is because they can be arbitrary in that there's certain tax rules that you can exploit to minimize or maximize your tax liabilities. There's depreciation, which isn't really a true cash expense in that year. It's you buy your products in year one, and actually it could last 10 years, so it's not a true different companies account for things differently. So some companies might capitalize assets that are over £1,000, whereas other companies might look at assets that are over £500 and capitalize those. So actually what it's trying to do is eliminate all those. It's trying to normalize the value of the business. So you're looking at true operating profit of a business rather than these non-operational items that can distort the profitability, the true profitability of a business.
Yeah, absolutely. So it's kind of like just like a baseline figure, right? It's so you can compare one business to another effectively on how it's run and not all the other deductions and stuff happening in there. So in the food manufacturing industry, what are we seeing? So you said the value of the business is a multiple of that EBITDA. So what kind of multiples are we generally seeing in the marketplace? Or what does that mean?
So the multiples would vary depending on the size of the business. The larger your EBITDA, if it's in the tens of millions, then you're likely to get a larger multiple. However, if your EBITDA is floating around up to the 500,000 mark, you'll be lucky to get 2 times the multiple. If you go up from 500,000 to about $1 million, then you're looking maybe 3 to 4 times. So it very much varies on, the multiple varies on the size of the business. The bigger the business, the bigger the multiple. And this is where we've come across in the past people undergoing something called a roll-up strategy, where they're buying lots of smaller businesses together to maximize the total value of the business. So when they exit in 5, 6, 7 years time, they can attract a higher multiple because they've merged 5 or 6 small businesses together, and they've hit the next threshold of EBITDA to attract the higher multiple. Yeah,
and this is something that business owners need to understand, all business owners actually, because there are some myths out there, right? Like some people think it's they pull numbers out of their bottom, or it's a multiple of their revenue is what their business is worth. But ultimately, it really boils down to what the EBITDA is and the multiple. And the multiple is, it's not something, it's based on averages, but a multiple of your business comes down to a few other things as well. It's a function to increase the multiple of your business. It's a function of the systems and procedures you have, how much the business relies on you, the dependency, how well your contracts are in place, what industry that you're in. All these things influence the EBITDA multiple. And, like we spoke about in the first part, you want to try and increase that multiple as much as you can. And part of that is by making sure that you set your, making sure that you set your business up properly from the back end. Okay, so we've got multiple, Jaz. What are some things that sort of tanks the valuation? Like, what are some things that will really decrease your multiple down that you're almost shooting yourself in the foot?
Yeah, so I guess the biggest thing is the over-reliance on you as the owner. So if you are the owner of the business, but you are doing everything's in your head, then you effectively are the business. The business cannot run without you. and that will massively reduce the valuation of your business. Also, one of the other bigger areas is customer concentration. So if you've got a business and 80% of your turnover is coming from one customer, if that customer decides to go somewhere else tomorrow, you don't have a business, or you've effectively lost a business. And then the other element we talked about is compliance gaps. So we talked about the VAT example earlier, but other compliance gaps. So if you've got a food manufacturing business and you're not complying with all the food safety regulations, that can massively undervalue your business. Any employee, not paying your staff national minimum wage, that could also undervalue your business, because any potential buyer can come back and say, well, actually, they want some warranties in place to protect them for previous years, because HMRC could come back not following the rules.
The rules. Yeah. I mean, these are things that we don't often think about as a business owner, right? Because we're probably thinking, wow, we've got a great high revenue business. Yeah, we have this amazing relationship with one customer who brings in the bulk of the revenue. What's wrong with that, right? But you don't, I guess the term that we often hear is transfer value. You don't really realize that until you actually go through a sale process on how detrimental that is to your business. So if you've got an inkling that you're going to retire, you're going to sell in the next few years, it's really important that you start looking at this now and start to figure out how you can diversify the revenue or income stream that's coming into your business, and really start working hard to kind of equal that out, and not be so reliant on one particular customer, even though that may sound fantastic to you. The other thing that I was going to say,
that coupled with having a contract in place with that customer.
Yes, I was just about to say that. Well done.
Right, sorry, take the words out of your mouth.
Why are contracts important? Like, why is that important to have contracts with your customer?
From the
seller,
the
buyer end, whichever way you look at it.
Yes, I mean, from a buyer's perspective, you want to ensure that relationship continues. A lot of business, especially in food manufacturing, is word of mouth and is on a handshake. But actually, once the ownership of the business changes, there's nothing stopping that customer going somewhere else. So actually, it gives the buyer comfort that actually that customer is committed for the next 2, 3, 5 years, whatever is stated in the contract. But also, the contract protects both the customer and the business owner as well. So, certain things around payment terms and credit terms and things like that. And with food, especially now with, all the allergy, Natasha's law around allergens and things like that. If you haven't got a watertight contract in place, that you as a business can be exposed. So, say you buy an ingredient from a supplier, you've done all your checks, or you've got all the relevant accreditations, and, say you buy something from a supplier who you've got a factory or production unit that has no nuts, and, you don't come into contact, but that raw ingredient has come into contact with nuts from the supplier end. Now, if you haven't got a contract in place to protect you against that, that's a liability that comes back on you, because you were the one who sold this to the end consumer. So actually, having contracts in place are not only relevant from a mergers and acquisitions perspective, but actually also protect you as a business.
One of the things when you're selling your business is there's going to be this conversation about what you think the business is worth, and what a seller will pay, and and what the bank thinks it's worth as well. So somehow we need to bridge the gap, and it's not, Jaz, it's not necessarily a fun conversation at times, but there's so many different elements to it, and it's about it's all about negotiating and understanding ultimately. It's going to be based on, unless you're selling to a trade buyer, the value of your business is going to be determined by bank conditions and ultimately what the buyer can pay for your business. But we just somehow need to come to an understanding of, what that valuation might be. And I guess from what we see is there tends to be a large gap between what you, the seller, thinks your business is worth and what the reality of the situation is.
Yeah. Absolutely. It's always an interesting conversation. having an independent person look at your business, like an accountant who's independent of your business, always helps bridge the conversation. And again, it's also how flexible you are in terms of getting your money, right?
Mm-hmm.
What we tend to find is when you're looking at businesses and the bank won't fund the valuation or the amount that the seller wants, you have to get a bit more creative. So if the seller is open to, having the money paid over a period of time, through seller financing, through other earnouts and things like that, you can, if you truly believe the business is going to work, then you can get maximum value that way. The banks are very much black and white in terms of what they will lend. They will take the previous 3 years figures and they will get a valuation based on that. Even though the forecast looks optimistic for the future, until you're in the future, no one's got a crystal ball really to say what will happen. But actually, there's other elements that you can get very creative with the seller. If the seller is open to it, you can get the value of the business.
Yeah, or even more, right? You can get that more. So one of the things that we see a lot is this comment of deferred consideration or seller finance. And that can be a really good idea for you as the seller of the business, because you can work that into your price and actually use that as leverage to increase the value of your business, and get paid out over time, which is not necessarily a bad thing. A lot of sellers think that by having deferred consideration or / seller finance, they're actually losing out. And they're probably scared that the new, what if the new owner of the business doesn't pay? But Jaz, there's so many
runs the company down is one of the things.
Yeah,
that we've
or runs the company down,
yeah.
Right? But there are contingencies that you and your legal team can take to ensure and minimize this. But the upside potential is so much more for you, the seller, if you really consider these things. And I wanted to talk about earnout, because earnout is one of those things where perhaps not a lot of business owners are aware of such a tool. And I think it's a really good tool, right? Because you might consider an earnout when you're, like Jaz said, you've had some stellar years in the business, or you're having a stellar year right now. And if you recall, Jaz mentioned that literally the value of your business is based on the previous year's the previous year's profits. So one of the ways that you can get the new buyer of the business, to pay for the future value of the business is by doing an earnout. So effectively, it's like, okay, you're the seller, you've got contracts perhaps in place, you're going to get this amount of business revenue is going to be coming in the next few years because you've done the hard work. But because the way businesses are valued, you're not going to be able to cash in on that, so to speak. But you can set up an earnout, and most sophisticated buyers would talk to you about something like that and having the value in doing that. You just mentioned, Jaz, one of the great ways that you can sell your business is to use an annuity type structure. So this is where you get a little bit of money perhaps on day one, but you can command a higher sale price, but you tell the buyer of the business, you just pay me out over a longer period of time. So when we talk to some business owners about this, there's a little bit of reluctance about, I need the money for retirement, or what if I'm not around, what happens? But you can actually set up, right, Jaz, some sort of structure like a trust you were mentioning, where you sort of get paid, you can set up payments for like the next 10, 15 years.
And, if you're in your 80s or whatever, and you don't think you've got much years left, your family can continue to benefit from that.
Yeah, and it's a tax-effective structure, and ultimately you can command a higher price for your business, and it works out to a win-win for everyone.
It's annuity doesn't have an end date, right? Until the business sells again.
Yeah, absolutely. Cool. So and I guess we should probably say, if you need some help valuing your business, or you need some help with that, please reach out to us, because Jaz and I can walk you through that process, and we can come up with an idea on what you think, an idea on what your business might be worth. So I just wanted to spend the next sort of a few minutes, Jaz, discussing basically the action plan, like if you've thought about you wanting to sell or now's the time, what sort of things should we be considering? If we can break it down into like maybe quarter by quarter just to clean up our financials.
Fine. Yeah, well, financials cleanup is the first most important area. So if you're doing the books yourself, get somebody in, get a professional to come in and have a look at them, make sure you're doing everything correctly, and just clean up any discrepancies, make sure the accounts are correct and showing the information as they should be. If you can, and this is not always feasible because it does cost a lot of money, but if you can get an independent audit done.
So now let's talk about how we bring this all together, right? So you're looking to sell your business. What are the steps that you need to take? We've spoken briefly about it, but what we want to do now is just sort of chunk it down into some monthly actions for you. So Jaz, months 1 to 4, where should you start?
Getting your books cleaned up for a start. So engage in, so if you don't have the resource in-house, engage in an external accountancy firm, bookkeepers to tidy up your books to make sure that the numbers are clean. There's no outstanding discrepancies and you're following the rules. And then I guess months 5 to 8, start documenting all the add backs. So all the personal expenses that you've had out of the business, start documenting those, build realistic projections for the next 3 years, what you believe the business can achieve. And then I guess for months 9 to 12, look at clearing any outstanding debts. So anything that's older than 90 days old, focus on those, get those cleared. Either get them settled, appoint a debt recovery agency if you can't if you're not having any luck getting them settled. If there's discrepancy around whether the work was done or not, write them off. It's going to have an impact on your profitability for that year, but actually you've overstated your profits in another year. So get the debts cleared out and then resolve. If you've got any legal issues, resolve those legal issues. What you can also be looking at is making sure you've got contracts in place with your employees, contracts in place with your customers, and contracts in place with your suppliers as well.
Yeah, I mean, it does sound like a lot of work, but as long as you break it down into those
chunks,
into those chunks, it's very, very manageable. And we should probably say, if you want some help in setting up your business for sale, please reach out to Jaz and I, because this is something that we can help you with and walk you through the process. But so, ultimately the sales process, when you're selling your business, the incoming buyer, they trust the numbers and not the promises. So, make sure to get yours audit ready. Did you have any other closing words, Jaz, before we finish this up?
I guess the other element to truly maximize the value of your business, once you've got all your ducks in a row in terms of your finances, if you could get an independent audit company to audit your figures, you're almost validating, you're getting an external person to validate your figures. It's a quality of earnings, what we like to call it. So this adds credibility and it helps increase the valuation of your business.
Yeah,
because your numbers have been checked by somebody independent.
Absolutely. And this is what it's all about. So good. Fantastic. So the next episode, we are going to be talking about one of the other levers that increases the value of the business is making the business run without you. We're going to be talking about systems and procedures and how to actually go about thinking that. So until next time, thank you very much for listening to the Forking Delicious podcast.
Thank you. Look forward to seeing you next time.
Bye.
Bye.